But when we import cider beer, the rate was 20%. So why are we taxing local production, more than imports? So what this laws amendment seek to do is to align. Now cider beer is also 47.5%. The implication again is on pricing. The import cost will increase, and if suppliers want to, transfer all the cost to consumers, then we should expect some increase in the price of cider beer. So if cider beer is your thing, please budget a little bit more in your next pages.
Okay, all right, Joachim. Thank you for that as well. So beyond the Excise Duty and the VAT Act, we've seen an amendment to the Customs Act as well. And what that amendment specifically is an amendment to the First Schedule, and which has introduced an additional 431 tariff descriptions to the customs tariff. And in line with government's objectives to make the prices of locally manufactured sanitary towels cheaper, there has also been an introduction of waiver of duty on the importation of raw materials that are used in the manufacturing of sanitary towels locally. We've also seen an amendment to the Stamp Duty Act, and the specific amendment is the increase in the rate of the stamp duty, and we've also seen an expansion in the scope of instruments that are subject to stamp duty on an ad valorem basis. And then there has been an amendment to the Exemptions Act, and specifically, this amendment covers the waiver of custom duties and taxes for imported fishing gear for agricultural purposes. So once importers are importing fishing gear and the purpose is mainly for agricultural purposes, there is a waiver of custom duties and taxes. And this is subject to the approval of the minister responsible for fisheries and aquaculture development and the minister responsible for finance. And the new kid on the block I mentioned, which is the introduction of the Emissions Levy Act. And what this act seeks to do is to impose an emissions levy on the carbon dioxide emissions from specified sectors. So the law is focusing on the construction sector, the manufacturing sector, the mining sector, the oil and gas sector, and then electricity and heating. So the expectation is players within this sector have a lot more carbon dioxide emissions. So this law seeks to impose a levy on their emissions on a monthly basis. And for individuals and users of vehicles, the Act also imposes an emission levy on internal combustion engine vehicles emissions. So for you and I and anyone else who uses a vehicle that runs on fuel, the passage of this law means that on an annual basis, will be required to pay an emissions levy. So that is what this amendment seeks to do. So thank you, Joachim, Gideon, and Betty. Let's check the regulatory landscape as well. And within the regulatory landscape in 2024, we are expecting an amendment to the Ghana Investment Promotion Act. And we've cited the bill. And now let me call on Jay to walk us through what the key changes are expected based on the bill that have been received. Okay, so now if you can help walk us through what the key changes are.
Thank you, John. Okay, so the Ghana Investment Promotion Center Act, currently there's a proposal to amend some provisions of the Act, and there's a bill in place that has been put before Parliament for consideration and passage. We've noted some few amendments which we believe are important for businesses to be aware of, and we'll discuss and later take your questions after this brief discussion. So the first proposed change is to upgrade the status of the center to an authority, which will grant it more autonomy in terms of the actions or the scope for which it is set up. Its scope is also being expanded to include the registration of all businesses in Ghana, or enterprises as they are noted in the Act in Ghana, and to promote the development of investment in Ghana. Another key proposal is in terms of the registration and renewal with the center. And currently, the registration with the center has a duration of 2 years, and it's renewable every other year. The proposal is to make the renewal annual going forward. So once this law is passed, businesses will need to update their compliance calendar to ensure that their renewals are updated every year. Now, another key, very important proposed amendment is the elimination of the requirements to provide a minimum capital when setting up a company. Now, entities that have foreign participation in terms of wholly owned foreign companies or partly owned, jointly owned with the Ghanaian citizen are required to meet minimum capital requirements upon registration with the center. Currently, for wholly owned foreign entities, they are required to register a minimum capital of 500 United States dollars. And for joint enterprises with a Ghanaian partner, they are required to register with a minimum capital of 200,000 United States dollars. Going forward, if this law comes, it's passed, this requirement will not be necessary. So any business or any individual, a non-citizen who intends to set up an enterprise in Ghana may set up without bringing in this capital, be it in cash or goods or a combination of both, or by showing their equity participation. So this is in the right direction, which is opening Ghana up for business and for investors. Because in our experience, this has been a hindrance to some businesses which are seeking to set up in Ghana. Now, the requirements, let me just quickly update that the requirements for registration in the current act does not explicitly apply to branches, but the GIPC has enforced the rules to indicate that branches or external companies are required to register with the center. This is being sought to be codified in the amendment, which will insist that all external companies should register with the center before they commence the business for which they were set up. Now, another key update is the removal of activities which are reserved for Ghanaians. In the current act under Section 27, businesses such as the setting up of hairdressing salons, barbershop, operating of taxis, printing of excise books are reserved fully for Ghanaians. Going forward, non-Ghanaians can participate in these businesses. There's, however, a caveat that for trading, it still remains that a non-citizen that intends to set up an enterprise to engage in trading is still required to meet the minimum capital requirement of 1 million USD. So that has not been taken away. Another proposed amendment is the revision of the duration of a technology transfer agreement, the registration period. Now, currently, the first registration of a technology transfer agreement may be up to a period of 10 years and renewable for subsequent periods of 5 years each. The proposal is to reduce this initial registration period to 5 years and renewable for subsequent periods of 5 years. Another rule that, or should I say, an offense that was not specifically stated in the current act is the offense of fronting. The new proposal states exactly what fronting means and states that it's an offense for a non-Ghanaian to represent, to set up a business, which in fact is actually owned by the non-Ghanaian, just to circumvent the requirements of the act. There's another provision which is quite interesting, in which this proposed amendment is seeking to put a restriction on allowance of deductions for cost or payments for services received under a technology transfer agreement, which is not registered with the GIPC. Now, this provision is arriving out of a vacuum that was realized in the appeal case of Based Off Ghana against the Ghana Revenue Authority, in which the court held in that case that the right to deduct or to deduct for tax purposes the fees paid to the service provider cannot be restricted, which GRA sought to do in that case. And therefore, currently, a company can deduct or is allowed to deduct those expenses it incurred for payment of such services, even if the agreement under which it is seeking to make the deductions is not registered with the GIPC. Now, the issue is this is purely a tax regulation, and the way it's being introduced in this particular provision or act as a way of curing that that defect that the court noted in that case is quite interesting, and we hope to see how this will play out if this law comes into its passed, or if it actually makes it into the passed amendment. So these are the key highlights we have noted that to look out for if this law is passed and comes into force.
Okay, now thank you for that. And then maybe I'll pick on the last change you mentioned and pick either Gideon or Joaquin's view on it. So the case now made reference to the Baisdorf case, taking into consideration the conclusion of the court in that case. Should this bill be the appropriate place where we seek to restrict the deductibility of such payments, or would it have been more appropriate to have it in a separate amendment to a separate law? So maybe Joachim or Gideon, if you could share your thoughts on that.
Okay. Let me take it. All right, John. So it's quite interesting. We all get the idea. It appears there have been some discussion between GRA and GIPC and the effect of that ruling. It looks like it's not a ruling that the GRA or the GIPC was really happy with, but that is the ruling. And it was quite clear that GRA cannot implement a law that is applicable to a different authority for the purpose of tax assessment. So the ruling was quite clear on this. So to still now make clear provision in the GIPC Act, which is not a tax law, and if the intention is for GRA to implement it for tax assessment, then I don't think that will be consistent with the ruling of the court. So I think that implementation will have challenges. GRA will have challenges with implementation, because it does not really change anything. If compared with the old law, it does not really change anything. The underlying principle of the ruling is that GRA, you cannot use GIPC Act to administer a tax law. And this provision is in the GIPC Act. So the underlying principles are the same, even as we speak. So if the idea is really to place emphasis and give relevance on this provision for tax assessment, I think maybe the right forum GRA could have used was to directly amend the Income Tax Act to include these requirements as a condition for deductibility. Yeah.
Okay, Joachim, thank you. Okay, Gideon.
Yeah, just to add a bit to it, and this is also an issue for me, which has been ongoing for a while, for the fact that we had this technology transfer agreement in Ghana at a time when we didn't have transfer pricing regulations, or in those times, it wasn't so topical. A lot of countries didn't have it. So the TTAs were put in place to sort of regulate this related party payments and transactions. We all know that since 2012, Ghana has had transfer pricing regulations, we recently amended it. And so the thinking was that once the transfer pricing regulations came into force, the TTAs would be done with, because in actual fact, they do tend to conflict in terms of what they stand for, what the TTA stand for, and what the transfer pricing stand for. But for some reason, for a while now, we've had the two side by side, and it's causing issues. And these are some of the issues which will keep on coming up, because they are almost addressing the same things here, but we have different regulatory bodies trying to oversee it. And I think it's time that the authorities take a step forward and then come out and say, well, we've recognized this thing for a while now. It's been under two different institutions, and it looks like none of these governing bodies is prepared to let go. And I think this rightly GRA's mandate, and they should be allowed to go on with it, whilst the GIPC also goes ahead with its own mandates to regulate other areas, and not when it comes to related party transactions. Thank you.
Okay, Gideon, thank you. So I think the intent is quite clear, although we are raising concerns around which act should be making provision for the deductibility of such expense. So for businesses that do have such TTAs that are registrable but are yet to register them, I think it is the right time to initiate processes to have these agreements registered with the GIPC. We have seen this in the bill, whilst we raise concern about whether that is the right bill to even contain this document. It just communicates what the intent is. So it would be right for businesses to take the necessary steps to be able to register such TTAs they have that are supposed to be registered with the GIPC. Okay, so now we move on to look at other key tax points that taxpayers should take note of in this 2024 calendar year. And I'll yield the floor to Joachim and then Gideon. Once we talk through the business tax issues, then Betty, you can come on. If there are any specific employee income tax areas, then you could also share that as well. So maybe Joachim, I'll start off with you. Then Gideon can come in to share some perspective as well before we have Betty giving us some comments around the employee income taxes.
All right, thank you, John. So, not that bit of unrealized exchange losses and realized exchange losses from transactions between related parties. So, the Amendment Act, which was passed last year, so this affects 2023 year of assessment. It was implemented around May, or so that it became effective. So from May to December, then these provisions would apply to you. Now, it's the amendment introduced some tier of deductibility, right? If you incur foreign exchange losses, realized or unrealized on local transactions, you are not entitled to any deduction. So that's the first step. Any exchange loss you incur, the first question you ask, is it incurred on local transactions? If your answer is yes, it ends there. Disallow the entire amount to pay through tax on it. Now, if it is not but incurred on foreign transactions, then it comes into two folds. Is it realized or is unrealized? If it is not realized, you don't get deduction for it. But if it is realized, then you get deduction for it, but subject to the restrictions under the income tax. So the restriction here means that the extent of deductibility shall not exceed foreign exchange gain and 50% of your adjusted chargeable income. So that is the level that you need to go to determine what exchange, foreign exchange loss you get that you can deduct, right? Now, John, let me also touch base on the use of GRA certified invoice as a base of expense. Yeah, this was also mentioned in the budget proposal. And as we know, GRA is coming to be working on implementation guidelines in terms of how it should be implemented. But this has come with a lot of concerns. I remember we came to see this, I think, 2022 or 2023, somewhere around that time, where there was an internal memo by the GRA for staff to implement. But then when it came out that the policy that was raised, they put a hold on its implementation. But I think now they are more, it's bold now, that's come up with the budget. So the GRA is taking the step to implement it. The concern here that people have raised concerns about, the legality of this implementation, linking that to the Madoff case, that, hey, you cannot use a different law to administer the tax assessment, for example, the respect of income tax law. So where specifically a VAT invoice is required to determine deductibility, are we not relying on the VAT law to implement CIT, or income tax assessment? It's a general question that has been raised. There are two positions on that. Some say the PRA has powers under the Revenue Administrating Act to issue such guidelines that the Commissioner General can, prescribe what an invoice looks like. And in the view of the Commissioner General, an invoice should be a VAT invoice. So be it. That is why it should be applied. But of course, the concern also raised by the legality bit and whether or not only a VAT invoice can determine expense deductibility is also genuine, which should be addressed. I know the GRA practice notes draft one is not out yet. And concerns around how will I know that somebody supplying this to me should charge VAT? First of all, is the person actually VAT registrable? How will I know? VAT registration is based on, one, the transaction to be a taxable transaction, and the person making the supply should have registered or is registrable to charge the VAT. Registration threshold is just 200,000 in any 12-month period. So, may the person be buying? How will I know the person is registrable? And this is a genuine concern that we believe should be addressed by the GRA to bring more clarity. And not all expenses, clearly business expenses, are subject to VAT. If you procure government services, government will not charge you VAT, but they are all genuine business expenses that you should be able to deduct. We believe that the practice will address all these concerns. So, a hard work purpose, you can see that the underlying principle is to promote VAT compliance, right? Using an indirect way to promote VAT compliance. But I believe that GRA should not push too much burden companies who are doing genuine business, carrying genuine expenses, and because we want to promote VAT compliance, it becomes an additional burden to deny them, deduction of expenses for the purpose of CIT. So, John, maybe if I have questions, I will leave here. If you don't have comments, you can come in to speak on that element.
Okay, Joachim. So we'll allow Gideon to share his views as well, and especially in respect of levies on imported services. So we know court rulings are part of the sources of law in Ghana, and we've had a recent ruling with respect to levies on imported services. So if Gideon can shed light on that as well in providing his comment, that would be very helpful.
Okay, thank you. Yes, you've rightly mentioned. So what we saw, we've seen the past couple of years, and we expect to continue seeing them, is that there's quite a number of cases now going to courts, finding their ways into courts than we previously used to see. So we even have a number of cases which has gone to the High Court, it's been appealed, it's gone to appeals courts, and we're even hearing some of these cases are going to Supreme Court. So this is very good on the part of the revenue authorities and also taxpayers, and testing the laws and seeing how the laws should be applied. One of these areas we saw recently, end of last year, and it's come out now, and I don't think a lot of entities have seen it or taken action on it. It involved a telecommunications company and the GRA. And this involved what we used to call, or what we call, imported service. And so where you are in Ghana here and you get services provided by a foreign entity, as compared to maybe importing goods, the services is provided by foreign entity in abroad or non-residents outside, and then it is consumed and used here. So we know that under the Act 896, the law was amended to make it so that you only charge or apply VAT when you, the recipient of the service here, use it for an exempt supply. It's a little bit complex, but let me say, so if you receive a service that you, the service provider, you provide normal services. So let's say you are into business of hoteling, for example, and somebody provides a service from Mauritius to you, the hotel company here, and you use it to provide your normal taxable hoteling business, then you do not pay imported service VAT. And so one of the telecoms entity took GRA to court on this issue. At the end of it, the court decided that, in fact, there were two main issues that the court decided on. One of it was that irrespective of whether you, the recipient of the service, and the example I use, the hotel company, uses the foreign service supplied in Ghana here for taxable or exempt, you are supposed to charge levies. I'll repeat it again. So the court said that you are in Ghana here, you are providing a taxable supply, irrespective of whatever you are using the service for, whether taxable or exempt, you have to charge your levies on. So, and this levy is the 6%, as I mentioned earlier, the 2.5, 2.5, and the 1. And this is quite significant. It means that if for all the services that are being imported now in your company and you have this sort of imported service and you haven't been charging levies, it's something that you look at. This came very late in the year and it's still being looked at, and I understand it might be appealed. But I think it's quite significant. It increases the cost of service. It changes a lot of things. And I have my own views on whether it is correct or not, but it is the law. That's what the court has decided on. The other portion, it's not so technical. It was how the company use the services in and whether they were distinct or not. And the court made a decision on that. But I think the main thing we have to take on this is the levies on imported service. It means that potentially for all the services that you'll be receiving and you'll be paying, maybe you have somebody providing software services, subscriptions, etc., and then you're using here, potentially you should be charging 6% addition on this imported VAT. So that's an area that we have to look out for. The second one I want to mention is transfer pricing adjustments. Usually a lot of interrelated party transactions, and we have companies making payments for transfer pricing, payments to their related party. If you have such adjustments and it's just a general, you just decided that it's going to be 5% or 10% or 15%, whatever rates you agree or arrive on, make sure it is substantiated. What exactly goes into this 5% or 10% or 15% transfer pricing adjustments that you are making on an annual basis? If it is not adjusted, you leave yourself exposed to having a TP audit, and then when it comes out, they would ask for 100% substantiating of such an adjustment. So these two significant areas is what I want to touch on, and I think taxpayers should be aware and start making preparations or talking to their tax consultants about it. Thank you.
Okay, Gideon, thank you very much. So Betty, beyond the update we have seen to the graduated income tax rate, are there any specific points or areas taxpayers should be looking out for, especially within the 2024 calendar year?
Okay. Hi, John. Yes, indeed, there is more to it. So the tax rates were amended due to the increment in the daily minimum wage. In the same vein, the net maximum insurable earning and minimum insurable earning has also been adjusted. So minimum has been increased. When you talk about the maximum insurable earning, it means the amount that net would accept, okay, as contribution for tier 1. Okay, so previously it used to be 42,000, but effective January 2024, it has been increased to 52,000 for individuals. And then the minimum is about sorry. So the minimum is also about 400 and sorry about that. 490 Ghana cedis, sorry. Yeah, so this doesn't really affect the staff cost or the employer cost in any way. The movement is merely between tier 1 and tier 2, right? So in Ghana, we have the 3-tier system, the tier 1 managed by SNIT, and then the tier 2 managed by the private fund manager or approved fund manager by the NPRA. So what SNIT is saying that the amount that we can insure for each individual is capped at this 52,000. And so any excess, which according to Deloitte internal practices, we recommend it's contributed into tier 2. So if you have an employee earning above 52,000 Ghana cedi salary, if SNIT is only accepting up to 52,000 contribution, or the salary is 52,000, then we recommend the excess is paid into tier 2. So it doesn't really increase the staff cost or the employer cost. Neither does it have any impact on the individual by way of increased or decreased earnings, but it's just a movement from tier 1 to tier 2. Yeah, so that's for the SNIT minimum and then maximum insurable end, or the SNIT basic salary cap. Now, another point of note would be the GRA's recent, not quite recent, but it has been in the pipeline for a bit, the review of or targeting of high net worth individuals, right? So who would we consider to be a high net worth individual? There's no, or the GRA has no real defined explanation or definition for these individuals. But in the finance space, they are deemed to be individuals whose assets and income exceed $1 million, right? So the GRA is looking into these individuals to confirm their compliance and ensure that they are reporting all their incomes, right? Now, does the GRA have the mandate to do this? Yes. And does the GRA have the right to request for information from these individuals' home countries? Yes, they do. Now, when it comes to the right to tax or subject their global income to taxes in Ghana, when expatriates or an individual is deemed to be resident in Ghana, it implies that their worldwide income is subject to tax. So it's not only the income that is sourced in Ghana, but every income received from any other country should ideally be reported and subjected to tax in Ghana. And so that is why the GRA has the mandate to get all this information in order to bring it to Ghana and then tax it. Now, another right or mandate to go to other jurisdictions for this information, which is actually in place, is an agreement that the GRA has signed on to, right? And this is the standard for automatic exchange of information. Okay, so once the GRA signed on to it, we have over 171 countries presently signed onto it. And what does that is that it gives financial institutions, right, a requirement to report all income assets of individuals who hold accounts with them. And so once the GRA has access to this information, and it's supposed to be an automatic annual reporting requirement. So it's not even when the GRA requests for it, but on an annual basis, all financial institutions are required to make this information available to the GRA. So with this information and information from all these other countries, the GRA has an overview of all the income that a specific individual is receiving. So if they compare that to what you are reporting in Ghana and it's not tallying, then it means either you are understating your income to be reported in Ghana, and so you would then be charged additional tax liability and potential interest as well. So how can individuals ensure they are compliant with this? So we have the annual personal income tax filing, which is due 4 months after the year end, right? So all individuals are required to file PIT, which is the personal income tax return, indicating all income received from employment, business, and investment. And then if these incomes are reported, taxes are charged on them, right? However, even though taxes are charged, individuals or residents have the room to utilize a foreign tax credit. Now, a foreign tax credit is income that is being considered in Ghana for tax, but we are saying the same income has been taxed elsewhere. And so the GRA gives you room as a resident individual to present a foreign tax credit to show as evidence of taxes paid on the same income. And so whatever tax the GRA calculates, it would knock it off against what has been paid in the foreign country. So, and this is not only limited to countries that we have the double tax agreements with the DTAs, with it's applicable to all resident individuals, whether we have a DTA with your home country or not. Yes. So how do we go be above or be compliant with what the GRA requires is to ensure that when this filing return is due, you ensure that all incomes are reported from all sources. So the GRA wouldn't have to chase you for that and then charge potential interest on it. Another aspect would be the introduction of a special voluntary disclosure program. So we are targeting high net worth individuals, but we are bringing this program. It's a proposal that is in place, and within the next few weeks or months, the GRA will probably release a publication on this. But this is some form of amnesty, right, for granting the individuals room to, on their own, disclose incomes or earnings or assets that they have previously not provided. Okay, so it then gives the GRA the right to tax this. But the benefits of being covered under this program is that any interest or penalties are dropped or disregarded. They wouldn't charge any interest or penalty on the tax liability. Whereas if you don't enroll under this and then the GRA embarks on its own checks and then finds out you have undisclosed income, then it means potential interest would be charged on any tax liability. So this will be enrolled within the next few. And so we are entreating all individuals, expatriates, and all that to ensure that once the filing obligation is due, they, as much as possible, report all incomes that are supposed to be taxed in Ghana, and then take advantage of the special voluntary disclosure program. Okay, John, so that would be it. On the mention of the tax filings, the annual tax filing, it brings me to the 2023 tax filing obligation, right, which is due in April 2024. Now, this is a bit special because there is an additional calculation required. And this came about because of the change in rates within the year. You know, the PAYE tax rates were amended May 2024. And so the paragraph 9 of the first schedule requires that if there's a change in rates within the year, a tentative tax calculation needs to be carried out in order to ascertain the total tax payable by an individual for the year. Now, what this means is that prior to the change in rates, the highest tax band was 30%, but a new tax band was introduced from May 2023 to December. So it sort of carries out a weighting such that the chargeable income is run through both the old rates and then the new annual rates, and then the weighting is done to get the total tax payout. So what we have realized in practice is that if your individuals or employees have high income from January to April, there's a likelihood that there would be additional liability because of the introduction of the tax rate, yes. So we would just recommend that this tentative calculation is done to ensure that the right taxes are reported for 2023. Thank you very much, John.
All right, Betty, thank you. Thank you. So one underlining point I think Betty stressed on, it's compliance. So for individuals, ensure you are compliant. For businesses, ensure you are compliant given the changes we have seen in 2024. Beyond these updates, so we had some publications by the GRA with respect to ride-hailing businesses and the requirement for them to pay VIT, vehicle income tax, on a quarterly basis from 1st of January 2024. We also saw a publication from the GRA indicating the commencement of the 10% withholding tax on lotto gross winnings by the National Lottery Authority and private lotto operators. That one too is supposed to be effective January 2024. And finally, a letter from the Ministry of Finance to the GRA and ECG indicating the need to implement the imposition of VAT on non-lifeline residential consumption of electricity. So for residential users of electricity who go beyond the lifeline usage, there will be the introduction of VAT on such usage. But we understand from the ECG that this policy is yet to be implemented. There are some stakeholder engagement ongoing, and then subsequently would see a decision made on whether the implementation would be carried on. So we have a lot of questions in the Q&A chat box. We will pick them and speak to them. But before that, let's walk through what the 2024 tax and regulatory calendar looks like. And this is the calendar we need on our tables to be able to ensure that in 2024, we remain tax compliant, both from a filing perspective and then payment perspective. So let's take note of these deadlines as we go through the year, especially for periods where the deadlines fall on weekends or holidays, and the obligation is for taxpayers to meet that obligation on the last working day before the weekend or before the holiday. So for monthly pension contributions, which is due on the 14th, let's take note, especially for in July, when we are filing the June return, which is due on the 12th, because the 14th falls on the weekend, and same for December, which will be due on the 13th of December. In the case of the withholding tax, PAYE, and withholding VAT returns, the obligation will be to file them on the 15th of the month, following the month the return relates. And as we've mentioned, especially in respect of withholding VAT, with the amendments we have seen in the VAT Act, failure to withhold and pay would come with an additional penalty of 30% beyond your obligation to pay the amount you fail to withhold. For monthly excise duty and VAT on imported service, the deadline is the 21st of the month, following the month to which the return relates. And as Gideon explained with respect to the need to charge levies on imported service, it is critical that taxpayers bear in mind this deadline so we are able to comply accordingly. With respect to the VAT and the levies and the CST, the deadline is the last working day of the month following the month the return relates to. So let's take note of those deadlines as well. And for companies with 31st December year end, critical dates we should take note of is the date for filing of our self-assessment returns. So the first quarter self-assessment return is due on 29th March. The second one is due 30th June, 30th September for the third one, and the last day of the year, which is 31st December, for the filing of the self-assessment return for the fourth quarter of 2024. And in respect of transfer pricing, there's also the obligation to file your transfer pricing return together with the corporate income tax return by 30th April. So for entities with 31st December year end, by 30th April, we'll be expecting that we meet this compliance obligation. And then by 31st December, we file the country by country report and notification for 2023. So it is critical that we have this calendar on our tables, on our desktops as our wallpapers, so we are guided as we proceed through the year to ensure we remain compliant as far as our tax obligations are from a filing and a payment perspective. So now we'll look at the questions we have on answers and unanswered and try to speak to them. And whilst at it, if anyone has any other question, you can raise your hand and you'll be allowed to unmute to ask your question. And my panelists here would help us address these questions. First, will be with respect to the amendment to the VAT Act. So Joachim, I think this one comes to you. There are questions specifically on what the rate would be with respect to rented premises for bank and then for a warehouse. So where you rent space for office and a warehouse, what the VAT rate should be. Should that go under the flat rate as well? So Joachim, if you can help pick that one for me.
All right, John, thank you. So I think I mentioned earlier that if you rent a warehouse and you are not an estate developer, then the flat rate of 5% would apply. But if you're an estate developer and you rent warehouse, then of course it will also qualify at 5% as well. But is it hotel? No, the next is other part hotel.
Yes, so you can add that as well for hotels.
Yeah. So hotel doesn't come under the flat rate. So hotel is a commercial rental establishment. So the hotel will still go for the standard rate of 15%.
Okay, right, thank you. So Gideon, there's a question on whether the VAT flat rate applies on non-life reinsurance policies as well. So I'll come back to pick you, but before that, I see Hudu's hand up. Hudu, so if you can unmute and then ask your question. Mutawakel Hudu. So if you can unmute, I see your hand up. If you can unmute and ask your question before I go to Gideon to pick his comment on whether the flat rate will apply to non-life reinsurance policies as well. Yes, Hudu, please go ahead and speak. You can unmute now. Okay, so if Hudu is not ready, let's go to Solomon. I see Solomon's hand up as well. So Solomon, please proceed. You can unmute and ask your question.
John, can someone unmute them because it looks like they are unable to unmute?
Okay, so Emmanuel, can you help unmute Hudu and Solomon? So whilst we wait for that, Gideon, let me pick your comment on the last question I raised. So whether for non-life insurance policies, non-life reinsurance policies, the flat rate of 5% would apply on those ones as well.
I'm not getting it well. Non-life. So this the amendment applies to just non-life. It didn't mention reinsurance, and so I think it's one of the areas that will need to be clarified. I remembered around 2017 when the scope of what qualified as financial service were amended. It included things like reinsurance. And by this time around, they didn't touch on reinsurance. They just said non-life. So it's something that it's as I said, the VAT Act is very specific. And so if something is not mentioned, I wouldn't want to include it there. But somebody could also sit down and say, well, non-life is not right, whether you reinsured it or not reinsured it. So this is a very practical example of some of the questions that will be coming up. It's just a month now. That will need to be clarified. So I think it's something that we'll pack and then we would also seek clarification. If you're also already in the insurance company, I understand the Insurance Association is engaging with the GRA on this. So it's a question or a guideline that will need to be provided.
Okay, Gideon, thank you. There's also a question on high net worth person. So someone wants to know who is considered as a high net worth person. Betty, if you can assist with that question for me.
Yes. So I indicated that the GRA does not have any set definition, but then they are going by the general finance definition, which says that the individual's assets and income should be more than $1 million US. So that's the threshold.
Okay.
But when it comes to the celebrities or public figures, they don't necessarily have to meet this threshold. They can go after them regardless of of whether they meet the 1 million USD or not.
Okay. Okay, right. Thank you. Solomon and Hudu, are you able to speak now? I see your hands are still up. Okay, Solomon's hand is done now. Erasmus Mensah, I see your hand up as well. If you can unmute and ask your question. Erasmus.
Yeah, good morning, team.
Okay. Good morning, Erasmus.
Yeah, so I'm Erasmus Mensah from Accra Brew PLC. Yeah, so on the levies on imported services, I wanted to find out, so what is the difference between the management from TP perspective? You know, we pay management fees, right, for services that our intercompany related party gives to us in terms of assistance, right? How is that different from the imported services that the act is referring to? I want clarity. Is it that we still have to go ahead and pay levies on those services, or because we pay withholding depending on the double taxation treaty with the country, we pay taxes on those, we withhold taxes on those management fees? Are we supposed to go ahead and charge levies on those services as well?
Okay. All right, thank you. Gideon.
Yeah, so thanks a lot for that question. Yeah, so first of all, I think we would then need to first clarify for your business whether it's really an imported service. The provider is outside of the country, it's provided for your use in the country. And when you take a look at the case, in fact, the judge went through that specifically, and you see a number of the line items are very normal. That's a lot of multinationals pay for, especially management service, other sort of technology assistance, etc., that parent companies provide to their related parties here in Ghana. And you find very similar type of issues. So after that, then we come to the next point, whether the VAT should apply. And then based on the service that you mentioned or your company, I assume you are a vatable company, you charge VAT on your services. So on that, it's then likely, based on the ruling from the court, that only the 6% would apply in your instance, because the judge said that irrespective of whether you are into taxable or non-taxable exempt, the 6% should apply across board. Something that I think I say I'm not in agreement with. And from what I heard, there could be possible appeals, etc. Until then it's appealed. That's what is law now. And I know with the GRA understanding this issue, they will go accordingly and start applying or enforcing what has been stated. So irrespective of the withholding tax issues, you would agree with me, even here in Ghana, there is withholding tax before there is VAT. So those are two different rules, and that have been applied. So you could have done the double tax agreement or etc. applying it, but when it comes here, it's saying the 6% should apply.
No, so we provide goods. We are a standard rate supplier. We provide goods. We charge levies and we charge VAT as well, right? So, so my confusion is the services we are receiving. So the invoice we receive from, let's say, the related party. Okay, it forms part of our expense. Now that invoice, are we supposed to now go and calculate 6% of the invoice and add it to our levies we are charging on the provision of our goods we manufacture? That's
yes. So that's an output VAT for that month that you pay. That there's an additional liability of VAT that you have to pay to GRA. Those who would know the previous version of the VAT law as it existed before this 896, we used to have that, but then you pay and then you collect, you pay and then you collect. So with this, it looks as if, because it's just on the level, the 6%, for that 6% that you are going to pay for that month, you have an additional charge. It's as if the person should have charged and paid here in Ghana, but because the person is not here, you are going to do that additional charging and paying on behalf of that person. So your cost or expenses goes up by that amount.
Well noted. What about a situation whereby the supplier, okay, so let's say I received a service, okay, in terms of for contract terms, it's not a related party. Okay, and the person has issued an invoice to me to pay. Are you saying that one too is my responsibility to add additional 6%? This one, I'm not looking at related party transaction.
Yes, it's, I was saying it was imported service. It's not related party. But Erasmus, there are a couple of questions. Let's take this offline and we can talk more about it.
Yeah, so Erasmus, maybe you
Okay.
can reach out to us a mail and we can deal with that separately. Okay, right. Thank you. So I see Joseph Opon's hand up. Joseph, yes. Please, you can unmute and ask your question. Okay, so while we wait for Joseph to ask his question, so Joachim, there are 2 questions on the VAT flat rate introduced. So if you could pick those ones for me, whether there is a threshold for those in the rental space before they apply the 5% flat rate, and then for landlords who are not registered for VAT at all, what is the implication of the coming into force of this law?
All right, John, thank you for your question. So I guess the question of the threshold is in respect of registration. So once you meet the registration threshold, so if your 12 months taxable supply exceed 200,000, then you are registrable. So once you are registrable, any type of supply you make, whether 5,000, 10,000, 15,000, you will charge the tax on it. All right. So the threshold only comes in at the point of registration or determined registrability. Once you qualify to register, and please let's take note that it's either you are registered or you are registrable. So if you are registrable, means you are engaged in taxable supply and your revenue exceeds 200,000. It's simple, 200,000. If you don't register with TRA and charge, of course, because before you can charge, you need to register with TRA, and then you'll be issued a VAT invoice. That is what you use to raise your invoice for the rent that you are charging. If you have not registered, later TRA can come after you and surcharge you for the taxes that you did not charge. So that is where the threshold comes. So please, if you can remind me on the second part.
So the second question, which is also linked, was in respect of landlords who are not registered when they're coming into force of this law. What then should they do?
Yeah, okay. It appears I read both together. If you have not registered, so I think maybe the other question on whether is an individual landlord should also register. Let's take note that the 5% is applicable in terms of the first group on commercial rentals, right? Not for dwelling. So if you are just renting where you are a family, you sleep, that's exempt from VAT. You understand? It's exempt from VAT. Unless it is commercial rental establishment, hotel, hostel, right? Those are the ones that it will be subject to VAT. So if the landlord here in question is giving out his house, his room for dwelling, then VAT is exempt from VAT. But if he's running it as let's say a hostel, you have 5 rooms closer to a school and you turn it into a hostel. If you estimate your annual income from the renting and it will exceed 200,000, then as a landlord, you are required to register for VAT and start charging VAT on the hostel fees. This time at standard 15% of VAT.
Okay, Joachim, thank you. So I see we still have a few hands up. Frepon NP, Ali Ilyasu. So any of you can unmute and then ask your question. I see Frepon NP. Yes, so Frepon NP, you can unmute and ask your question.
Hello. Hello.
Hi, Frepon. Yeah, please go on.
I'm Ali Ilyasu. I'm joining from Dubai.
Okay, Ali.
Right. When I used to be in Ghana, I used to work with a company. We used to pay the standard rate. We rented a warehouse, but we were paying the standard rate for VAT. So I don't know how this 5% is going to impact on this standard rate we're paying for the warehouse. is it that we should expect a change from the standard rate to the 5%, or we should still expect the standard rate?
Okay, Ali, thank you. So, as we earlier mentioned, with the coming into force of this Amendment Act, the invoices for the warehouse rental now should be subject to VAT at 5%. So, we'd expect the landlord to now issue the invoices with VAT at the rate of 5% and not the 15% you used to receive. Okay. I see Hagar of first hand up as well. Okay, Frimpong, you have unmuted, so you can ask your question. Frimpong NP.
Hello. Yes, can you hear me?
Yes. Kindly speak up a little bit for us.
Okay, can you hear me?
Yes, it's better now.
Okay, so my question is with regards to the realized and the unrealized FX. Last year, as in 2022, we made huge FX losses. So a greater portion of it were deferred. And that portion, we have to amortize it over 5 years, both realized and unrealized. So my question is, right now that we are saying that they are going to allow only the realized. What about the one that we deferred 2022? Are we going to be allowed to use the 20% of it in the 2023 financial year in the assessment of our CIT?
Okay, all right. Thank you, Frimpong. And so Joachim will pick that for us. Joachim, if you can help respond to Frimpong's question, yes.
Okay, all right. So thank you, Frimpong, for your question. So one thing about the exchange different loss or financial cost restriction, let me put it that way, is that when you carry it forward to for any year that is carried forward, it is being deemed as incurred in that year. All right. So you have 2022 carry forward 2023. It is being deemed as incurred in 2023. So it will be subject to the same rules as applicable in 2023. That means that it is only the realized portion that can be subject to deduction. That can go through now the deduction slip to see how much more you can deduct. It doesn't mean the realized portion, you can still keep track of it. Once it becomes realized, then we can now continue to deduct
that. Okay, thank you, Joachim. So I see Hagar Ofer and Shaibu. So if you can unmute and ask your question. So Hagar Ofer and Shaibu. Hagar Ofer and Shaibu. So if they could be allowed to unmute, then they could ask their question. Okay, so whilst we wait for them, there's a question here. So someone was asking whether the 5% flat rate would be charged with the COVID levy, as we have in the case of the 3% flat rate. Gideon, would you like to speak to that one?
Yeah, and that's what we said. We are now looking for guidelines because it looks like that's what they did for the 3%. Maybe they might do that on the 5%. We don't know yet. It might come up with the guidelines because the law wasn't specific, and then nothing showed us how they haven't played their hands yet. So it's something that we'll still have to watch out and see what the GRA says at the end of the day.
Okay, thank you, Gideon. We're running behind time, so maybe I'll pick one more person who had the hand up, then we can proceed. For those with unanswered questions, you can drop them in the Q&A chat box. We will put them together, provide responses to them, and share them across. So I see one with the name Crown School. If you can unmute, you can allow him to unmute, him or her to unmute, and then ask the question. Crown School. So Emmanuel, can you allow Crown School to unmute and then ask the question? Then we can have Good News also ask the question. We can pick these two. Then for the other questions, we can put them together, provide responses, and share with the participants. So Crown School, you can now unmute and ask your question. Okay, so if Crown School is not ready, good news, you can unmute and ask your question. So that can be answered before we proceed. Good news.
Unmute.
Yes, we can hear you. Please proceed. Good news, please proceed with your question. I'm sure he's having challenges. Okay, so this is what the time would allow us to take. For any unanswered question, please put them in the Q&A chat box. We will put them together, provide responses, and then share the responses with you. And allow me to share Deloitte School of Tax 2024 training calendar with you. So for the 2024 calendar year, these are the trainings we have lined up from now to the end of the year. And it will be good to have you join us for any of these trainings. So block your calendars, make a time, join us. Let's have educative sessions while we work through these interesting tax and regulatory topics. So on the 27th and 28th of March, we're having our corporate income tax masterclass. We have the IFRS 7, where we look at the convergence of accounting and tax principles, given that we have IFRS 17 in place now in April. There will be a tax training for non-profit organizations in June, and we have one on corporate governance on Ghana's companies income tax lined up for July through to the last one in December, which will be on VAT principles on and compliance. Also, to get access to up-to-date tax news, we advise and recommend you download the Tax at Hand app. So you can get tax news from Ghana and the rest of the world on the Tax at Hand app. You can scan the QR code we have here to download the app, and you'll be able to get an up-to-date information on everything tax happening around the world. Thank you very much for joining us today. It's been an educative session. And thank you to Joachim, Gideon, Betty, and Na for sharing your views and thoughts with us on the key amendments and then what the tax and regulatory landscape looks like within the 2024 calendar year. So whilst you leave us, we would like to hear from you. You can scan the QR code and let us hear from you, your review comments on the session we've had today. And for those with unanswered questions, we'll put those questions together, provide responses to them, and then share them with you. Thank you very much once again for joining us, and do have a good rest of the day. Goodbye.
Bye.
Recording stopped.